If you own a house in the Austin area, there is about a 100% chance that its value has gone up a lot over the last couple of years. Now that increased value could mean higher property taxes, but that increased value also means more equity and a higher net worth. Now if you sold your house in the last year, you might consider getting with an accountant and do a little tax planning. Since prices went up so quickly, and because so many buyers are willing to pay over the list price, when it's time to file your income taxes, you might be surprised to find out that you owe capital gains taxes on that sale. Now the bad news is if you don't realize you owe these taxes until it's time to file your return, you may have already spent the money or reinvested it in another house. Stick around for this video and I'll tell you all about it. Now before we get too far into this, let me make a quick disclaimer. Nothing in this video should be considered tax or legal advice. The IRS is very good at providing mountains of information regarding current tax policies. All I'm doing in this video is relaying my understanding of those policies. If you have questions on tax law specific to your situation, please consult a competent professional. Now our current capital gains law came from the Taxpayers Relief Act of 1997. Prior to that, if you sold your home, you didn't have to pay taxes on your profits if you bought another home of equal or greater value within 2 years. This is kind of like a 1031 exchange on investment property. Now in addition, people 55 and older could use a one-time exemption to avoid paying taxes on up to $125,000 of home sale profits. But in 1997, the Taxpayer Relief Act became law and the rules changed. Instead of rolling your profits into another home purchase, you got a flat $250,000 exemption. In other words, if the difference between what you sold your house for and what you bought it for was less than $250,000, you paid no capital gains tax on it. The only requirement that you must have owned it and lived in that home for at least 2 of the 5 years prior to the sale. And married couples could shelter up to $500,000. Now those exclusion limits haven't changed in 25 years, while home values have nearly tripled. In 1997, when this law passed, the median home sale price was $145,000. In the first 3 months of this year, that median home sale price is $428,000. Remember, that's the national median price. Some areas were much higher than that. In the city of Austin, for example, the median sales price was close to $650,000. And to clarify, median means that half of the homes sold for less and half of the homes sold for more. Now back when this law went into effect, having a taxable gain on a home sale was relatively rare, outside of high-end properties and some high-cost cities. But with the price increases we've seen over the last couple of years, this is no longer the case, especially if you bought your home 5, 10, or 20 years ago. Now the first step in determining your gain is to identify the amount you realize from the sale, which is the total sales price minus any selling costs, including real estate commissions. After that, you'll need to figure your tax basis. That's generally the price you paid plus certain closing costs and improvements. Now the higher the basis, the lower your potential taxable profit. Let's say after subtracting selling costs, you realize $600,000 from your home sale. You originally bought it for $200,000 and you remodeled the kitchen for $50,000. You'd subtract the $250,000 from the $600,000 to get $350,000 in capital gains. Now if you're single, you could exclude the first $250,000 of that gain, but would be liable for taxes on the remaining $100,000. Now, long-term capital gains are normally taxed at 15%, but if it's big enough, you could get bumped up into the 20% bracket. Now, this is for federal taxes only. If you sold your house in a state with state income tax, you would also be liable for any state taxes. Now, if you're married, you could exclude up to $500,000 of gain. So in this example, you wouldn't owe any capital gains tax. Now your tax basis could be lower than your original purchase price if you previously deferred gain. Let's say you sold a house before 1997 and rolled $175,000 of profit into the new house, the one you cost you $200,000. The initial tax basis on that would be only $25,000. Using the same example, if you realize $600,000 from the sale, your capital gains would be $525,000, even with the $50,000 kitchen remodel. Now, other factors can increase your tax basis and lower your taxable capital gains. For example, If you owned a home with a spouse who died, at least half of the basis would be stepped up or increased to the market value at the time your partner died. Now, this is one area you should definitely work with a tax professional on because it might be possible to step up both halves of the house's tax basis if you live in a community property state such as Texas. Now, another way to increase your tax basis are the cost of home improvements. According to the IRS publication 523, Selling Your Home, to qualify, the improvements must, quote, add to the value of the home, prolong its useful life, or adapt it to new uses. Room additions, update to kitchens, and new plumbing would count, but repairs or maintenance such as painting usually won't. You also cannot count improvements that were later torn out or replaced. I would highly suggest you start with that publication 523 to understand which costs can reduce your gains and keep all the documentation, especially receipts, in case you get audited. Be proactive with your record maintenance because we all know that if you try to go back 10 years and try to find an old receipt, it might be difficult to find it. You know, I get emails, texts, and phone calls almost every day from people who are thinking about buying or selling real estate here in the Austin area, and I would love to help you out too. If you like this video, you should check out this other one that I did. And don't forget to subscribe to my channel and hit that notification bell. All of my contact information is in the video description, so don't be shy. Let's make your real estate dreams come true.